If you've been looking at a Lake Geneva Airbnb or Door County vacation rental or another high-end investment property and your lender told you you're tapped out on conventional financing, listen carefully.
It's the Mortgage 101 podcast where real talk meets home and life.
You're probably not out of options. You're probably just looking at the wrong loan products. And honestly, most investors in Wisconsin have never had a DSCR loan explained to them in the right way. Welcome to Manley's Mortgage Minutes, powered by the Mortgage 101 podcast. I'm Manley Haines, and every week I break down what is actually happening in today's market so buyers and investors can move forward with clarity and confidence. Today we're talking DSCR loans, one of the most powerful tools available to investors who want to keep scaling properties without getting boxed in by conventional lending rules. No fluff, no smoke and mirrors, just how the numbers actually work. What is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. Now, don't let the fancy mortgage acronym scare you off, because the concept is actually simple. Traditional mortgages qualify you. A DSCR loan qualifies the property. That means no tax returns, no W-2 obsession, no traditional debt-to-income calculation. The lender simply asks one question: does the property generate enough income to cover the payment? That's it. The formula is monthly rental income divided by the monthly housing payment, principal and interest, taxes and insurance. Super simple. PITI. If the property cash flows well enough, the deal works. So, real world example. You're buying a $950,000 short-term rental near Lake Geneva. 4 bedrooms, hot tub, walking distance to the lake, the kind of place that stays booked all summer and still pulls strong winter weekends. Instead of using long-term rental numbers, DSCR short-term rental loans can use AirDNA income projections based on comparable Airbnb performance in that market. So let's say the projected gross monthly income comes in around $87.50. You put 20% down, the loan amount is roughly $760,000 at today's DSCR rates, and your principal and interest payment lands around $5,300 a month. Add taxes and insurance, and your total payment comes in around $6,700 a month. Now, run the math. 8,750 divided by 6,700 gives you roughly a 1.3 DSCR factor. That property qualifies, and the lender never once asked you for your tax returns. Why this matters. This is where DSCR changes the game for investors. A lot of higher-end long-term rentals in places like Brookfield, Mequon, Whitefish Bay don't cash flow well enough under conventional math. But short-term rental markets, Lake Geneva, Door County, Wisconsin Dells, those markets generate premium nightly revenue that can completely reshape the numbers. And here's the bigger issue that most investors eventually hit. Conventional financing starts getting restrictive once you stack multiple properties. DSCR loans, they don't care nearly as much about how many financed homes you already own. Each property stands on its own merit, and if the next property cash flows, you keep scaling. Here's the trade-offs. Now let's keep this honest. The DSCR loans are not normally the cheapest available financing. Rates are typically a little higher than conventional loans. Usually you need to put at least 20% down. Reserve requirements will be a little stronger, about 6 months needed. Plus, many programs include a prepayment penalty. But here is why serious investors still use them. Flexibility. A lot of DSCR loans can close in an LLC structure, helping investors separate business assets from personal debt exposure. That matters when you're scaling higher-end properties, because eventually, preserving personal borrowing power becomes just as important as acquiring the next deal. All that being said, these trade-offs can actually become a trade-in with the right mortgage professional. And hey, there are levers that can be pulled to get your DSCR product into a place that competes and sometimes even beats conventional rates. If you want to learn more, don't hesitate to reach out. Here's the bottom line. If you're buying your first rental property, conventional financing may still be the better play. But if you're self-employed, scaling investment properties, or moving into a high-end short-term rental space, DSCR loans become one of the most important tools in the toolbox. And in markets like Lake Geneva and Door County, where short-term rental demand stays strong year-round, understanding this strategy can completely change how fast you grow. Thanks for watching this week's Manley's Mortgage Minute. If you're looking into investment properties and you want help running the actual DSCR numbers, including projected Airbnb income, reach out and let's strategize it together. And don't forget to check out the Mortgage 101 podcast every Wednesday, where Anthony and I break down what's really happening real time in the mortgage market and in the housing market. I'm Manley Haines. I'll see you next week.